You are watching Trading Day. One of our trending trades right now is the Mullen Group. The shares are a little bit lower as the company highlighted that the end of the holiday quarter was a little bit softer than expected, but they say they're more optimistic about 2024 than they were this time last year. For a look at the source of that optimism and what happened at the end of 2023, let's bring in Murray Mullen, Chair, Senior Executive Officer, and President of the Mullen Group. Murray, always a pleasure to speak with you. Let's just get the quarter that you reported out of the way, because it seems like you were chalking it up to just how the calendar fell in the quarter.
Yeah, hi, Amber. Great to chat again. Well, basically the quarter was not that bad. We were actually up from 2022, but, the way kind of the holidays fall with, you lose kind of a whole week now at the end of December. So really a lot of our businesses fell off a little bit, but generally speaking, I mean, if you're up from 2022, 2022 was a fantastic year, and we beat 2022, I'm pretty pleased with that. I'm not sure why some shareholders maybe they were expecting more. We were going to beat it by more, but, with me, I just tell it the way it is. And we were just about spot on with exactly what we'd highlighted and we said we were going to do. So, but 23 is over, and we got to set our tones at 24. And, there's some confluences going on. There's some things in the economy that I think are giving a lot of us that are dealing with consumers a little bit of stress these days. But then there's also opportunity on the M&A front if you got a strong balance sheet. And, that's half my job, is making sure we're well positioned for the future on the balance sheet side. So.
Well, let's talk about maybe the reasons to be optimistic for 2024. Is M&A part of that? Because there was, saying that you're more optimistic this year than you were the same time last year.
Yeah, and the reason is that, when we get excited about M&A is usually when some of our competitors and our friends in the business run into a little trouble. And high interest rates and high debt levels are definitely hurting a lot of people today, individually and businesses. And we will be able to probably find the right price point now and bring in those right businesses into our group so that we can grow and drive value in the future. So we've already announced one deal for this year. And based upon how many deals are coming across my desk every week, I suspect we'll be able to do more because, as I said, Amber, we got the balance sheet in the right position. So most of our optimism is we're going to be able to pick up some really good assets because the price point's coming down in line, and we got the balance sheet to do it.
So that's interesting, because so much of the narrative coming into 2024 is, we're doing it. We're pulling it off with respect to a soft landing. Things are robust. There might be no landing at all in the United States. Things have been so robust that we've even pushed out the prospect of rate cuts in both sides of the country. Is your experience, what you're seeing on the ground, a little bit different, painting a different picture of how 24 might play out?
No, I don't think it's different. I think it is. When you do M&A, you got to have a long-term view, right? I mean, you're not doing it for a quarter or for the next 3 quarters or whatever. You're building something that you'll have for 10, 20 years or something like that. So M&A, you got to take a long-term view. But I can tell you, if those interest rates don't come down pretty soon, you're going to have a lot more pain in the economy. Too many people are getting hurt by high interest rates. They have to come down.
So let's talk about that, because right now, based on what the Bank of Canada is saying, what the market is pricing in, they're not priced in until September. And I know that can change, and that's market pricing. But even economists don't think it's going to show up in the first half of this year. It sounds like from where you're sitting, you're saying we could use these rate cuts a lot sooner.
Well, if you ask myself and other people that are in business, we'll say, you got to get your foot off our throat here. It's hurting the economy. So just remember about the central bankers and the Fed and all them. They were late to the party and didn't raise interest rates fast enough. I would tell you they're late leaving the party. They
What's
got to
the
cut.
consequence of that? I mean, you talked about it possibly being good in terms of being able to scoop up M&A, buying things at a lower value, but there's also, these high rates, how they affect ultimately demand, but business executives like yourself and others that think about, should I be investing right now, investing for growth?
Well, I think that, on a couple commentaries from others that were just before myself, you're hearing the same thing. Consumers have got money, but the money doesn't go as far today because of inflation and high interest rates. So they can't buy as many goods. And that hurts Canadian Tire. That hurts retailers. That hurts the trucking industry because the freight demand is not quite as high. So the average person is really, really under pressure today because of inflationary pressures and because of high interest rates. And they may be going together today, in my opinion, because you're not going to be able to get housing prices down unless we can bring mortgage rates down. And mortgage rates are too high, and the cost of running a business is very high today. If you were paying 2% for a mortgage and now you got to pay 7 or 6, you don't have as much disposable income. Businesses are exactly the same way. If they're paying more to interest, so you're going to be crimped, and a lot of businesses run off of balance sheet, off of having debt. So I think that's the biggest problem that I see. And before they take their foot off, it could cause too much damage, and then it's going to be tough to repair again, and away it goes. So I think they've done a great job. There's a lot of, I don't see as much inflation. I can tell you, we don't see much inflation in our business. Most of the customers that we're talking to, they're under pressure, which is why they're putting pressure on me and our businesses and my competitors. So I think they keep looking at data. The bankers look at data backwards. I'm looking at data forwards, and I'm saying it's not quite as good as what they are predicting.
Well, that's interesting because then it also affects the decisions you make, whether it's on investment or trying to find cost savings elsewhere. The labor market has been tricky because it's been tight. And there has been kind of a push on the driver side, the so-called Uberification of truck drivers as a way to perhaps save on the labor costs and not employ truck drivers outright. Where does the Mullen Group stand on that?
Well, look, I think that everybody would say, Amber, is that you'd like to have an equal playing field in a business. I think you're talking about the Driver Inc. model.
I am, yes, yeah.
Yeah, so, that's just a way for some companies to not pay benefits and to pay their people, the same as what a large carrier would. Now, but that's not my issue. That's a CRA issue, and that's a government issue that they got to rectify that. What I can tell you is, and it doesn't really impact Mullen Group because I never invested in those businesses that compete with competitors that have the Driver Inc. model, because I can't. We treat people fairly. We want to make sure that they're looked after. So we just avoid investing in those sectors of our business that you have to compete with them head to head. Our business model does not compete with them head to head. I know a lot of my peers do, and they're frustrated, but nobody's going to listen. The CRA is not going to listen to me or to our industry. They have to listen to the little person. But it's not fair, but it is what it is. And my job is to allocate capital where I think we can do well. And I didn't see, when you're competing with somebody with a Driver Inc. model, you're at a disadvantage because labor is your biggest cost in transportation. And they have a distinct advantage by not paying people the same as what we do, as an example.
Murray,